Okay, good morning, everybody, and welcome to the first January briefing from Symmetry Financial. So my name is Mark Solon, and I'm here with my colleague, James Tully.
Hello, guys. Happy New Year. Hope everyone's keeping to their New Year's resolutions.
Yeah, we haven't broke ours yet, have we?
No, absolutely not. No sugar, no alcohol.
Yeah, as we bait into a box of donuts. So this morning we're going to, so first of all, thank you for those of you that have listened into our webinars last year. They were a bit sporadic. We didn't have a structure on it. That will change this year, and very much appreciate the feedback we've got, and good and bad. And we're trialing Zoom this morning, so you will notice a different layout. So hopefully it will run off without any glitches. So without further ado, and just in case you haven't listened in before, I'm going to assume that you are familiar with the company at this stage. So Symmetry Financial, we're based in Dunboyne, 9 staff, 8 full-time, 1 part-time. We do have national coverage, and we look after all elements of financial planning. I think that's fair to say. Yeah. So James is getting a good experience in terms of the overall financial planning and not just the world of investments. Yeah. So, but these webinars really are about the investment world, the investment space. Yeah. How people savings and cash investments, anything basically to do with corporate money, pension money, personal cash. Really, what we're trying to do with the webinars is give information that hopefully some of you find useful, and I know in 2021 we made some we gave some highlights and some instructions, and I think people overall were happy within the year. But we are a long-term strategy. Yeah, very good.
Recommend, even in this webinar, we kind of have a couple of individual plays or sector plays, but we will always tell our clients to have a 10-year view, and to pick a fund which is spread across geographies, sectors, and companies.
Yeah, so if you're coming to talk, coming looking for the next quick win, or you're coming looking for a short-term 2 to 3 year window of investing, we have some really low-risk stuff. We wouldn't really classify it as investing, but anything that has risk on, you are literally talking a 7-year plus, not the 5 years that the industry utilizes. And as all our clients we educate, that 5 years is purely to do with the exit penalties and the commissions and the profits that the insurance companies obviously say that they work hard to make. Okay, so in relation to this morning's webinar, we're going to have a quick look back at 2021. We're going to have James is going to talk about the impact of the Federal Reserve meeting from November 2021. Then we're going to have a little look at the outlook, a few themes and a few companies and a few concepts for 2022. So there's some interesting plays and some interesting information in there. So just to kind of recap 2021, we will, and I'll summarize it at the end, we will cover the insurance returns, insurance fund returns on our next month, along with a few other ideas. But this is just to give you an idea of what's actually happened in the market over the past, well, obviously over the past 13 to 14 years, but in reality over the past 3 years. So 2018, what was the big thing that happened?
Yeah, so it's kind of like a flashback, I suppose, kind of now as what 2018 was. So Jerome Powell came in as head of the Fed and was proactively raising rates, and this actually eventually caused a correction of about 20% over Christmas.
2018,
2018,
the end of the year.
Yeah, and then ultimately he had the Powell pivot, stopped raising rates, and it's just been off to the races ever since. So I suppose we're kind of coming back more to that territory now, where he's trying to raise rates. So is it a case we get a correction? Who knows? There's still a lot of QE floating around.
There is
still low rates as of now, but things could be changing.
Yeah. So again, just to highlight the importance of understanding the impact Federal Reserve and interest rates, either increases or decreases, have on the financial markets. If you by chance started your investment career in 2019 and you were investing in something like the S&P 500, you've doubled your money over that on a compounding basis over that 3-year period. Obviously, we are in jittery territory now in terms of inflation figures, which we're going to talk about in a second. But just looking back, the most recent window would have been 2018. Janet Yellen jumped ship, Jerome Powell came in, interest rates started going up, and stock markets started going down, and it was the last negative year for the S&P. So, yeah, are we potentially anticipating something similar this year?
Yeah, definitely wouldn't rule it out.
Yeah, neither would I. So, just bearing in mind where things are at. So yeah, so I mean, it's over to the Fed. So the Fed meeting then, James.
Yeah. So in November they released their minutes, and then they actually will speak on the minutes and the meetings that they have. And the real big worry is, is inflation. So beforehand, when they kind of kept monetary policy very loose, the whole buzzword was, transitory inflation, transitory. That's what we kept on hearing. And in November, Jerome Powell actually said he wanted to retire that word of transitory inflation for the meetings going forward. So it's very, very clear that the Fed is hawkish, which means they want to tighten monetary policy. And that has, massive impacts, financial markets, but also on just regular people's lives. So I'm going to kind of highlight in this next slide what I'm talking about. So as you can see here, it is a really good chart. This is like essentially the financing rate for the US. Okay, this affects car finance, mortgages, among other things. But as rates have been moving lower, which everyone knows they have been, inflation has been well below. Okay, but as you can see here, so this was 2015, 16, 17. They can keep rates quite low. But as you can see here now, inflation is so far above, the federal funds rate, which is basically the cost of financing. So that something has to give there. And if you look at previous examples where you've seen this, interest rates have shot up.
Rocket. Yeah.
Now we all remember, well, I don't, but the 1980s when there was very high inflation and also very high interest rates. So it's definitely something to keep in mind. And this is what the Fed are really kind of worried about. And they're in a bit of a between a rock and a hard place.
Yeah, absolutely.
So,
and I know we're here talking about the world of investments, but it crosses over to the webinars we cover on the longer term interest rates with mortgage pricing in Ireland. Again, this is the Fed, so this is North America. It's not the ECB. Just to clarify that for clients, why are we using the Fed for these webinars? Because we're talking about the investment markets. But if you're talking about the borrowing markets, you will be talking about the ECB. And we're seeing similar trends in the ECB zone. The 3-month Euribor hit positive territory for the first time in 7 or 8 years, just recently. That's from a negative 0.5%, heading back into, when we say positive territory, zero. So we're at zero in terms of the short term, but it's really the longer term pricing then and what impact it will have on the 10-year. I think we're going to talk about that in relation to the US, but it will have similar impacts in our territory, which is what we're concerned about. Okay.
So I suppose as a result of that meeting, there's been lots of changes in the financial market. So a couple of examples here of high growth and highly valued companies. So all these peaks that I'm kind of highlighting here are in November, and that's around the exact same time that the Fed came out with these minutes talking about how worried they were about inflation and the potential of maybe 4 rate hikes this year is what some traders are pricing in. So you can see here just a massive drop from 370, I believe, is the high on this. It's down to 178 now. It's the same with Cloudflare. There's a plethora of other companies that have the exact same chart. And these companies don't make money. They're fantastic businesses in the long term. They're the stuff you want to own for the long term. But in the short term, these have got killed. Will they continue to be killed? It's hard to say. I think it's definitely not something I'd want to own for this year. Long term, definitely. So it's affected high multiple, high valuation shares.
And just on that, if you go back to that slide, so just something that James educated me on, and it was the terminology instead of the PE ratio, which won't exist for these growth stocks. So these are the stocks, as James pointed out, they make no money. So at the end of their financial year, they're reporting a loss, but they have high revenues in terms of year-on-year growth. So what happens is investors come in anticipating that the companies are going to make a profit and will be profitable at some stage in the future. So you have this price to sale ratio, which gives you a measure of what time frame really.
Yeah, so it's like the actual multiple is the revenue that that company brings in, and then it's divided by the market cap.
Yes.
Okay, so it's the only one to really look at for these types of companies. And it's, you know, like, I mean, like Steel Limited was 20, this one here is like at 93, and they've already have like had a massive correction. So it's just insane valuations, but it's not to say that they can't grow into them. Like when Steel Limited first went public, they made about 500 million a year, and now they're up to 5 billion in a couple of short years. So if that trajectory of growth was to continue, and then they eventually start turning on the profitability factor, like Amazon have done in the past, these companies can, you know, worth a lot of money. But anyway, we will keep moving forward. Also, another variation of the high multiple, high valuation shares are the COVID winners. So Zoom, Peloton, and they've also just been decimated.
But a big call out to Zoom. It's revolutionized our way of doing business.
Currently hosting our
and it's currently hosting this webinar. So we're not going to knock Zoom, but
no, not too much.
Again, if you had been eyes open in early to mid 2020 with the changes in the work practices, businesses closing down, you saw an opportunity to invest in Zoom, you would have done exceptionally well over the subsequent 8 months. But from its all-time high of just under $600 a share, it's had a nasty fall back down to where it's priced at today of just over $160 a share. Again, Peloton, not necessarily a household name in Ireland, but you were telling me an interesting fact that they've actually stopped production of their bikes because there's no market.
Yesterday of recording this, as I was getting my screenshot of the chart, it fell about 25%. Again, and based on they're just stopping production. But yeah, two interesting shares. In my opinion, Peloton is really just a cycling bike with an iPad. Zoom, I think there's a lot more interest in Zoom. But they need to kind of find ways of actually turn it into more profitable business. So I suppose we'll keep going. Again, how important was the Fed meeting in November? It was just huge. So it's like liquidity coming from the tap. And when that seizes up, the stuff like the high multiple, high valuation shares get hit, and stuff like cryptocurrency also gets hit. Still believe in cryptocurrency over the long run, but you know, it's just money comes out and it needs a home. And when that excess money is stopping to flow as easy as it has been over the last 24 months, you know, you are going to see a pullback in this type of stuff.
I would estimate I have the conversation around cryptocurrency with investment clients 5 to 6 times a week. I'll be asked about it. And what is our one mantra when it comes to any risk asset, but in particular cryptocurrency, is averaging. So what we mean by that, again, for those of you that may have missed it before, is you average into these investments. So you don't put in your 50,000 euros in January the 14th and you see in the markets drop by 15% and you're saying, well, I'm never doing that again. That was terrible. You take your 50,000 or your 5,000, whatever that figure is, and you average it in at 500 a month or 1,000 a month, and you do that over time. Yes, you can get lucky, and we have clients that have done exceptionally well and been very, very lucky in terms of when they bought, but we have had clients that have been the opposite and have been extremely unlucky. How do you eliminate that risk from longer term views in this space? Is you average in. Do I still see, and does James still see a space for Bitcoin and a space for Ethereum and the larger cap cryptocurrencies? Absolutely, they're here to stay. Don't anticipate, and we're putting our word on the table here, don't anticipate them going anywhere, but they are extremely volatile. They don't have a class for volatility to cover the likes of cryptocurrency. So on the scale of 1 to 7, they're a 10, if you want to put it that way. But if you are looking at the concept of the technologies and what they bring to the market, and this is a global solution. I was reading an interesting article only this week in relation to cryptocurrencies as a possible hedge against inflation in some developing countries where the inflationary pressures can have dramatic and drastic impacts on the value of their currencies. And they're looking, I mean, we've already seen it with Salvador and a couple of other countries that are looking at using these as potential currencies within their marketplace. So, you know, it's a long way to run. We're still early in this space. If you are investing, average. Okay. Yeah, always will be. That will never change. So dominant themes, this is really interesting stuff. So I'll hand it back to James.
Yeah, so I mean, we covered kind of really what happened in 2021. January was very, very strong for the equity markets, but certain aspects done really poor towards the back end of the year. And then some stuff done really well. So like financials, energy, done really, really well. And I think personally myself, it's going to continue. We look at the UK kind of dropping all restrictions on the 26th of this month. The Irish government came out, I think, last night, and it was fairly seen to be getting back to normal. So, you know, if that is the case, and everything that we discussed about inflation and inflation affecting interest rates moving higher, the higher interest rates move, the better financials do, because they can get money at say 0.5% or 0.25% and loan it out at a 10-year at a 1.8. So they get more profit. So it's a fairly simple concept. If you believe the economy is going to move back to where we were, continue to grow, you know, financials is going to be a one to own. The next one.
And again, just on that, before we get into energy, because that requires time in itself. Again, it goes back to the concept of a basket of goods, where you are investing not necessarily in one asset class. You have yourself distributed based on your risk appetite. You decide, I'm going to take a percentage of equities, I'm going to take a percentage of bonds, I'm going to take a percentage of alternative investments, property, etc. So if the equities, depending on the equity makeup of that portfolio, if the equities are taking a bit of a hit, but you're seeing an increase in the value of your bond or property because of inflation, then you're going to see one balances out the other. So you're not going to have that, what we lived through many, many times in the past, the boom to bust scenario in terms of the value of your money, unless you are very, very specific and you're speculating and investing in very, very finite industries or finite sectors. So again, watch the space. Let's see how it progresses as the year goes on.
Yeah, no, Mark is definitely right. You know, we want to own a diversified fund. For instance, if you have 20% in each sector, you know, the technology sector, which is 20%, might do poorly, but the 20% that you have in financials and energy, you know, will balance it all out. So,
and it's worth pointing out there, actually, I'm only after on the financials, the figure there, you find on the financial figure there, this is the financial companies within the S&P, and their return in that 28. So we showed you earlier that the S&P 500 doubled your money between 2018 and 2021. Your financial companies pretty much stayed still. Whereas since the start of this year, even when inflation started becoming an issue earlier in the year, obviously the Fed made the announcement in November, but it was been highlighted much earlier in the year. You can see that the financial markets was already starting to be priced in to their share price. Longer term, you know, people anticipating inflation pressures to come down the line, obviously leading to yield increases, are benefiting them. Okay, so again, just worth pointing that out. So moving on then very quickly, on to another beautiful topic of commodities and oil price. So where are we going there?
Higher, I think. Again, we've done webinars on this before, and it just comes down to capex. It's non-existent, but you know, in places, you know, in the Western world, we still use a lot of oil, but in the East, so Indonesia, countries like that, their oil demand is still growing. So it's just a very, very simple concept. It's unfortunate, because this is what really affects us on the price of everything, is oil. You know, my hope would be shale production in the US starts to really grow, and hopefully at some point the powers that be step in and give the nudge to the Saudis and the Russians to up production, because it's not good for you know, anyone really if oil moves up to 100.
Filling your oil tank, or filling your, if you're not fortunate enough to own an electric car, filling your tank. You notice it. You will have noticed it over the last 12 months. and likely to notice it going into the future. So WTI, so crude, was an all-time high as recently as 2009 at $150 a barrel. More recently, it was in around $120 when it had that significant crash 18 months ago, 20 months ago. If you had a big enough hole in the ground, you could have taken a delivery of oil for free. In fact, they would have paid you to take the delivery of the product. Those days are well and truly gone, with demand growing, economies getting back to full speed. So again, it's another important part, another element to bear in mind, and I would certainly be including an element of it in any portfolio if you're constructing it. Okay, and then lastly, looking at a couple of shares of interest. So you picked these two, in fairness, yeah.
Yeah. So again, personally myself, I think the equity market will have a bit of a weaker year this year. Again, we don't know, but if I had to own stuff, I would be moving out of the non-profitable tech portion, and I would be buying stuff that has profits, and then their underlying assets are going up in price. So BHP, Rio Tinto, they're the largest producers of copper, iron, base metals, a huge amount of other lithium, and really nice dividend, very attractively priced.
You're looking at a dividend on Rio Tinto. I was even surprised when we were going through this, dividend yield of 8%. So again, for those people that may not understand that, if you own $10,000 or $100,000 worth of this, or euros worth of this share, they're paying a dividend income on the value of the shares when you bought them. So potential income there of 800 quid or 8,000 euros or dollars on an annualized basis, and BHP a little bit higher. These are very, very attractive yields, and you can see that even the share price, while they're not necessarily at all-time highs, the share price has recovered and has been recovering since pretty much the collapse of this space over the last 5 years. So again, worth watching, worth being aware of, and not necessarily saying you'd invest in one or two of the particular companies, but you would look at an index that tracks that particular space, a portfolio of commodities companies or a portfolio of trading companies, and there's plenty of ETFs, etc. out there that James and myself will be happy to look at with you. Okay. And then the last play you've covered here was lithium.
Yeah, so again, it kind of fits in with the whole mining trend, and it's a very simple concept. Even in Ireland, over the past 4 years, demand for EVs has just been, insatiable. So you've had
electric vehicles, again, just for everyone hopefully understands the term at this stage.
So it was 4%, 4 years ago, 8% the year after that, 16% last year, and now 24%. So, and what I mean by those figures is, of new cars sold, those percentages were EVs. So it's doubled every year. That's exponential growth in the EV market. Also, you have players like Audi, Volkswagen really pushing EV now, as opposed to some niche players like Tesla. So it's become a lot more broader. So what you want to do there, you want to own companies that, this is the largest, it's Canadian companies, the largest lithium producer for batteries. So again, it's a simple concept. It's done really well, and I think it's going to continue to do well. Also, it does actually make a profit. So again, they're the type of shares that I kind of want to stick with. And on the left-hand side, you can really just kind of see the imbalance across lithium over the next couple of years. So again, it's a really good company to own. And this extends past lithium. Nickel is another one, and there's some other metals that is used for, say, semiconductors. And the demand is just not going anywhere. So
Okay, guys, that's us for this week. For this month. So we'll be back in February. We talk about the insurance industry. We compare the results from all of the providers. So you may remember the 2020 figures. Zurich were the runaway victors. So it'll be interesting to see what the outcome was for 2021. I think it's going to be fairly flat in terms of how they've all performed. We look at a few alternative options, so we didn't want to confuse it this morning in terms of some of that alternative stuff we talked to clients about. And let's see how January finishes up. So we've still got 10 days to run. Markets dropped last night. There's the fear of Russia invasion on Ukraine, Biden kind of shooting himself in the foot, really. So
the cat out of the bag there, Joe.
a little bit, Joe. Yeah. So let's see what Joe and his buddies and Putin and his buddies decide to do over the coming days. And we're saying ingest is serious.
It's a
Very serious topic, yeah, because it impacts pretty much everything we're after covering. So I will be listening in and watching that space from an investment point of view, as well as obviously from a geopolitical.
Yeah.
That's it, guys. So listen, thank you very much. Really appreciate it.
Thanks, guys.
Keep sending the feedback, and we will talk to you next month. Okay, bye now.